I received a question earlier today that was basically, how do I start investing? How do I put my savings in investing? What's the best way for me to, to just start off the bat? And my advice to anyone who's starting out, new and hasn't invested in the stock market before is to buy incrementally. The reason 401k plans and other retirement plans like that work, generally speaking, and return for the vast majority of people money, and the reason on the opposite side, the reason a lot of people lose money also is because of dollar cost averaging. Now, you have to understand when you are going in to buy into the stock market that it is impossible to predict what is going to happen. It's impossible to know if the prices will be higher or tomorrow. What we do know is over a long period of time, the purchasing power of a dollar declines. And because the dollar is designed by the central bank, the Federal Reserve, to decline in purchasing power over time, or also that inflation is a target of the Federal Reserve, which means that it's trying to target a reduction in purchasing power of the dollar. What that means for stocks is that stock prices over the long term will increase, because stock prices are just representing prices in the economy, where money is going in the economy. If more money is going to banks in terms of interest payments because of rising interest rates, bank stock goes up. If more people are spending money on Amazon shopping, Amazon goes up. So all it's really doing is representing that, and cash flow and earnings and things like that, they go up with prices. When prices go up, the famous when prices go up, stock prices go up. The famous example I use is that a fruit seller, if the price of an apple goes today from 50 cents to $1, he probably likely won't, in 10 years from now, be selling less apples. What that will just do, if the price doubles in 10 years, is make the amount of money that the apple seller is bringing in, the revenue, to double. It will go from 50 cents an apple times a million apples, $500,000, to a million apples times $1, which is $1 million. So you see how that works, and that's the bet you're basically making in the stock market. But you're betting that the biggest companies will actually outperform the growth in terms of dollar figures than you would get with something like a treasury bond. You're betting that the moves that are going into those top 500 stocks in the S&P 500, that those 500 companies are that big because they're in, for the most part, growing parts of the economy. So the money is shifting towards those 500 stocks, and that's what the S&P 500 that you always hear about, that's what the S&P 500 represents, is the 500 biggest stocks. So if a stock becomes now in the top 1,000, not in the top 100, 500, it's dropped and another stock replaces it. So the S&P 500 will always replace, the hottest sectors of the economy that are, taking up the most money, that people are spending the most money on. And so in the long term, it should go up. Now, that doesn't mean it will for certain. In places like Japan, in places like Europe, there were huge market crashes that, the markets have not recovered from now, and that in Japan was 30-40 years ago, and the market still hasn't recovered. So if you were invested at that time at those high prices, you never made your money back. So there are instances where that can happen. Can that happen in America? Absolutely. There is a chance that could happen. We just haven't had that occur yet, and it's mostly because our industries were, unlike Japan's, the growth expectations weren't as big back then. In Japan, they had, the mentality that Japanese companies will dominate the world in terms of electronics, in terms of automobiles, but we saw that wasn't necessarily the case. And when people get happy like that and the money keeps coming in, there's the greater fool theory, which indicates that, as long as there's someone stupider than you to say, well, it's went up 100% this year, I need to get in now before it's too late. It keep going up and up and up. And by then, those people are, of course, getting in too late and buying from the people that got in earlier that are selling to take their profits to the pocket. So you could be a victim of this. Now, the best way to trade or to invest is incremental purchases. The SPY is the S&P 500 ETF, and a smart way to invest is, of course, to just buy the S&P 500 on a weekly basis or a monthly basis, a way where you're accumulating shares over time rather than just taking that money. Don't take $10,000 and buy into the S&P 500. Buy in over time. This way, if you took that $10,000 and broke it up into $1,000 a month over 10 months, you'd be buying a longer term trend. So you would either be, if the prices are going down, you would be averaging and getting your average price lower. If the prices are going up, yes, you're not making as much profit, but you also reduced your downside risk dramatically. And there will be times in that 10 months where you will be able to buy cheaper than you otherwise would have if you were buying 100% at that time period. So that's why 401ks work, because people are average pricing. When the market is down, they're still putting money in. Instead of just taking those losses, they're bringing the average price down. So when the market does go back up and recover, their profits are greater than they would be if they just stopped investing at that point and held. So dollar cost averaging, as it's called, is your friend, and that's how you should be investing. What you should be investing in is either in the index, which is really one of the safest ways to invest in the market, because you're not picking winners and losers. Picking winners and losers doesn't work. Day traders and people that think they could outperform the market usually fail miserably. You may outperform the market one or two times, but over your lifetime, you're not going to outperform the market consistently every year. And in fact, even professionals don't. 96% of mutual fund managers don't outperform the S&P 500, and the ones that do don't do it for a long term. They do it for a year or two, and then it's back down to underperforming again. So that's what really sucks. If you're going to be saying, well, I'm going to buy this stock, it's going to double. It probably won't, and you'll probably lose a bunch of money, and you'll be happier if you just put it in the S&P 500. Remember, investing is a long-term game. You're not there to make money in the next year or the next 2 years. If you try to do that, your money is not being put to use. Your money is being put to use by making sure that you're buying a diversified portfolio of the top producing companies in the United States of America. And so you want that, because if you buy the S&P 500, you're buying 20% of every dollar you put in is going into tech stocks like Apple and Microsoft, United Healthcare and other big health companies. 15% of your money is going into there. 13% of your money is going into banks. And another 20% is, or more even, is going into consumer discretionary and consumer staples. So you really, in that case, are really investing the best way you possibly can. Another great way to invest is to buy these dividend stocks, and not just any dividend stocks. I'm talking about the higher dividend stocks that are within the S&P 500. Not just any dividend stock you see, because there's reasons why a high dividend can result in a lower stock price tomorrow. A high dividend does not necessarily mean that it's going to continue on that dividends. What you need to look for when you're buying dividends is, number one, is the company actually in a position to grow over the time period that I'm holding this? And number two, how often is this dividend paid out, and what is the percentage? How often are they increasing the dividend? If the company is increasing their dividends for 10 years or more, that's a good company to invest in. There's also aristocrats, which are companies that for 25 years or more have increased their dividends. And you need to consider that when you buy those high dividend stocks, you hold them for a short period of time, you can't make money on them. But when you hold them over the long term, the dividend that you're getting paid out is really reducing the risk you have associated with that. So if you're getting 4% a year on your money, after a certain amount of time period, you will have made back the money that you put in there without having to depend on the fluctuation of the price of the stock. Of course, if the price of the stock goes down, they could still increase the dividend in terms of percentage and still be paying less of a dividend. So that's something to consider also. But you could also look at something like an ETF, which is an exchange traded fund, which is a lot like a mutual fund, but usually is tied to an index. And there's something called VYM. It's Vanguard's high dividend stock. They pay it's tied to an index of the higher yielding dividend stocks inside the S&P 500, and that with time will do really well for you also, because they're all huge companies. They're not going anywhere. You could sleep safe at night knowing your money is in there. Even if the market drops, it'll come back and you'll get those there. And when the market drops, the money floods into those high dividend stocks because people want that guaranteed earning on their money. They don't want it just sitting there without a dividend with the additional risk associated, So if the market goes down 20% 1 year, you make that up with the 5 years of the dividend that you just got paid. So when the market does decline dramatically, it's your losses are really over the long term minimalized. They're not nothing, but they're less than they would be if you were holding stocks without any dividends. So look at those. Now you might be asking yourself one thing: how am I going to buy 1 share a month or 1 share a week with a $10 commission? If I want to buy 1 share of let's say VYM, it's $75 around right now, and you're saying that's $10 that I lose right off the bat. It's almost like I'm buying it at 65. That's why you should use the RobinHood app when you first start, to accumulate shares, to build your positions. And then you may want to move to a more legitimate broker, or not legitimate, because RobinHood is, for all intensive purposes, a legitimate company. The thing about Robinhood is it's cheap because there's no features on the platform. You need to do your research elsewhere, and you're just using Robinhood to hit the buy or sell button. But Robinhood lets you buy and pick up these things with 0 commission. So you are automatically, when you have 0 commissions, beating another investor, because even though your returns may not be less, you have to think about how much you would have spent in commissions. It's $10 to buy and $10 to sell in most on TD Ameritrade, let's say. So if I want to buy 20 shares of VYM, that's $20, and I'm already down $20 just on the purchase and the sale. So if you're using Robinhood, you could save money that way, and that way you have more room for the stocks to drop. And because dollar cost averaging works extremely well with Robinhood, extremely well, because over the long term, dollar cost averaging does work. And if you're using a regular broker, then you make 10 trades a year, buy and sell. That's $200 that you otherwise would have had in your pocket, or otherwise would have bought more shares with. The one thing Robinhood doesn't have is a dividend reinvestment plan, which is, it's not the most urgent thing for you, because you could just get those dividends and then buy more shares with them yourself. But there is a dividend reinvestment plan which automatically takes dividend the company or the ETF pays you and invests it right back into that stock. So if you get let's say the stock is $100 and you get a 4% dividend, after 1 year you'll have 1.04 shares or something like that. It's not an exact science because it depends on the price fluctuations of the stock, but more or less, yeah, you accumulate shares with time as you do with the appreciation. So it works in your favor to have a dividend reinvestment plan. Robinhood does not offer that. So you have to, the dividends come in cash to your account, and then you could do whatever you want with the cash. Some people use the cash as some people really use the cash as cash. They use it as income. It's a way to supplement your income while your money is tied up, so that you could pay bills or whatnot with it. Of course, it's smarter to reinvest it, because you're getting compounded interest on top of compounded interest. And with VYM, you would have doubled your money in the last 5 years doing that. And that's the case for a lot of these big wig Vanguard ETFs. They're really good because they're really low cost. I think it's like 10 basis points or something for VYM. So you see how cheap that is. A comparable mutual fund is like a point and a half. And here you have 10 basis points compared to 1.5%. It's a fraction of the cost. And 1% on your money over time adds up. So whenever you're buying these things, as good as they look, always look at the expenses associated, because once you take into account expense ratio, which is what the fund is charging you to manage, plus commissions, you're done for. An extra percent in commissions in expense ratio plus a $10 commission on the purchase, you're screwed unless you're investing tens of thousands at a time, which I don't do that, and I don't recommend you do that. I recommend you do dollar cost averaging. If you're doing this in a different type of account, a lot of ETFs are free. So if you want to buy ETFs, you could buy them, but you can't buy individual companies, or you can't buy a lot of ETFs. There's a few that every broker offers. A lot of them are Vanguard. Those are really good ETFs. So if you want to use TD Ameritrade or Schwab or something like that, and you want to invest in those, diversified holdings through ETFs, you can do it for free. They don't charge commission, so you wouldn't even need Robinhood. But I recommend Robinhood because you could buy just about anything you want on it. So no matter what your strategy is, if you want to buy leveraged ETFs, you could get them for free. If you want to buy regular stocks, one share of this, one share of that, you could get them for free. So Robinhood works in your favor in the long run. So just to recap this video, what you want to do is either invest in an index or invest in something a fund that gives you a very diversified group of holdings that are tied to an index, not tied to what some fund manager thinks is going to happen tomorrow. There's no predictor of what can happen. If you want to day trade, or you want to swing trade, or you want to trade for a profit in a taxable account, you'll probably lose a bunch of money. That's the truth. You can't beat the market. You just can't. It's too difficult. It takes too much time. And when considering all the effort that you're putting into beating the market, you could just take that and get another side job, or while your funds are in the index, and you'll make more money that way. So it really is something that you don't need to, these 401ks and these IRA accounts. And the reason why people in mutual funds make a lot of money over the long term is because they dollar cost average. They're always buying in. They're getting interest on top of interest on top of interest. And they're not betting which way the market is going to go in the immediate future, or even in the short-term future. They're holding 30, 40 years. The dollar is going to decline in that time period. The cash flow of companies is going to simply increase just because the dollar is declining. And you're just betting on inflation. That's all you're doing, is betting that there's going to be inflation, and you're betting that you're going to be one step ahead of the manifestation of that by buying an index which is weighted by the sectors that have the largest market cap of companies. So whenever that balance is that's being rebalanced, you're not losing the value the way you would if you were just holding that sector, because the new sectors that are taking over the market share are coming back and creeping up in terms of their weight inside the S&P 500. So that's what you want to do. That's your best investment strategy. And no matter what type of account you're doing it in, an IRA account, a Roth IRA account, a health savings account, a student college savings account, those are the safest ways to do it. And that's what you need to do, and that's what you should do to start. Open an account with Robinhood. It's like $5 you can put in. You could put in $1. You could do anything and just learn how it works. But when you're buying one share at a time, or you're buying smaller amounts and you're not paying commissions, you could have that luxury of taking the time you need to really teach yourself how this all works and to participate without risking a lot of money and without losing money on things like commission. So you really should be doing that. Robinhood, 2 thumbs up for Robinhood. It really levels the playing field for you as a new investor, because you're buying things you otherwise couldn't buy because of commissions. You're saving that money, and you're able to build a really diverse portfolio for yourself without paying commissions, and by buying, one share at a time of this, one share at a time of that. And that's what I do personally. If I have an idea about a stock pick, I don't go in heavy. I'm not one of those people that puts thousands behind something just because there's a chance it could go up. I'll buy 1 or 2 shares in Robinhood and leave it. If it makes money, it makes money. If it loses money, it loses money. I lose a few bucks. It's not such a big deal at the end of the day. It's also beneficial for you in terms of that you could set up like recurring deposits, and you could save your money into an app like Robinhood. Anyway, in your savings account, you're getting jack shit for that money anyway. So if you put your money into something like Robinhood and you're buying these indexes over 3 to 5 years, it's likely you'll make interest on it, a lot more interest than you'll make in a savings account or by buying bonds or anything like that. And you could do it in a way where it's like a savings account, an automatic withdrawal from your bank account, set it and forget it. Go in once a month, buy whatever you want to buy, set that and forget it, and come back next month and don't even look at it. That's the trick. The trick here is to buy dollar cost average, set it and forget it. Once you buy, consider the money gone until the certain point in time in that you're older and that you've matured enough and you've been trading and buying enough that you can make the decision if it's time to withdraw the money. If God forbid, you need the money for whatever it is. But that's a way to let it grow with interest, the way that you would have a savings account with a lot more interest, is to use something like Robinhood where you can buy in right away and dollar cost average all the time. Representing prices in the economy, where money is going in the economy. If more money is going to banks in terms of interest payments because of rising interest rates, bank stock goes up. If more people are spending money on Amazon shopping, Amazon goes up. So all it's really doing is representing that, and cash flow and earnings and things like that, they go up with prices. When prices go up, the famous when prices go up. I received a question earlier today that was basically, how do I start investing? How do I put my savings in investing? What's the best way for me to, to just start off the bat? And my advice to anyone who's starting out, new and hasn't invested in the stock market before is to buy incrementally. The reason 401k plans and other retirement plans like that work, generally speaking, and return for the vast majority of people money, and the reason on the opposite side, the reason a lot of people lose money also is because of dollar cost averaging. Now, you have to understand when you are going in to buy into the stock market that it is impossible to predict what is going to happen. It's impossible to know if the prices will be higher or tomorrow. What we do know is over a long period of time, the purchasing power of a dollar declines. And because the dollar is designed by the central bank, the Federal Reserve, to decline in purchasing power over time, or also that inflation is a target of the Federal Reserve, which means that it's trying to target a reduction in purchasing power of the dollar. What that means for stocks is that stock prices over the long term will increase, because stock prices are just stock prices go up. The famous example I use is that a fruit seller if the price of an apple goes today from 50 cents to $1, he probably likely won't, in 10 years from now be selling less apples. What that will just do if the price doubles in 10 years is make the amount of money that the apple seller is bringing in, the revenue, to double. It will go from 50 cents an apple times a million apples, $500,000 to a million apples times